Let's start. We were on the Forex. Let's quickly come to last question. I think we discussed was 37 to 38. Seventh we have done it. Move to something new. Exchange rate determination theories. Exchange rate determination theories. I'm on slide number 13. Now I have taken some data here. Let's suppose someone has $1 lakh and the rate is $1.60. Interest rate in the dollar is 0 and rupee is 10%. Now generally it appears rupee is giving a much more higher return. Then I have done two things. Bring this dollar 1 lakh at the rate of spot to India, it becomes 60 lakh. Invest at the rate 10%. At the end of 12 months they'll become 66. Now while going back, if the forward rate $1 is 60, they'll go back as $1,10,000. If the rate is 66, they'll go as 66 lakh divided by 66. $1 lakh came, 1 lakh will go. And if by chance the rate is 70, then 66 lakh divided by 70, 94,286. If you look at, if the dollar would have stayed back in the US itself, in the US $1 lakh would have been $1 lakh, no change would have come. But if they come to India, it converts to 60 lakh, becomes 66 lakh. While going back, first process gives arbitrage profit. That means it's advisable to come to India and invest in India, because you bring $1 lakh, earn interest in India. When you go back, it goes 1 lakh 10. Whereas if they would have stayed back in the US, the $1 lakh would have been $1 lakh only. If the rate becomes 66, whether you stay in the US, 1 lakh becomes 1 lakh, or it will be 1 lakh same. Or if the rate is 70, in that case it was not advisable to come to India. So we have something called, one is interest rate parity theorem. The interest rates are so adjusted such that we arrive at a rate which gives no arbitrage. That's this process here. Second part is, the arbitrage happens in the, if the rate is any rate other than $1.66. If the rate is 60, there will be arbitrage. That means it's advisable to come to India, stay in India for 1 year, earn the interest and go back. You'll be able to earn some profit out of it. If the rate is 70, it is not advisable to come to India, but we can follow the reverse process. Reverse process would be, let's suppose you borrow 60 lakh in rupee, go to US, 0 period become $1 lakh. You stay in the US, $1 lakh remains $1 lakh. Come back to India, they'll convert at the rate of 70. You'll get 70 lakh in hand, and interest cost in India is only 10%. So in third case, if the rate is 70, it is not advisable to come to India. It is advisable borrow in rupee and go and invest in the US. We'll be working out on all three. First part is how to arrive at this IRP, that means interest rate parity. Second part is, if rate is other than this rate 66, depending on the interest rates what we have in the two countries, then this would lead to the arbitrage possibility. Arbitrage process, how do we do? Two type of questions. One is IRP will ask you. Second is, if the IRP fails, there would arise the arbitrage opportunity. How do you arrive at arbitrage opportunity? That we'll look into. Now let's quickly write down interest rate parity. First theory. There are two theory. One is based on the interest rate parity theorem. Second is based on the purchasing power parity theorem. First is interest rate IRP or IRP. As per this theory, the exchange rate between two currencies are determined by the rates which prevail in those two countries. Let's suppose $1 is equal to T. Same thing if I take, let me take the interest something. Let's suppose interest in the US is 2%, interest in India is 10%. So in US it will become 1.02. In India the item will become 66. So if I try to create a parity, $1 should be equal to rupees divided by 1.02. That's $1 is equal to rupees. How much do we get? 66 divided by 1.02. 64.71, 710, something. Now I wish I could have done this way in the exam, but as per the theory what we apply, interest rate parity is the forward rate divided by spot rate 1 plus right hand side currency interest rate 1 plus LHS currency. Actually, if you try to look at this, 64.71 is a forward rate. Spot rate was 60. What we have done is, if I would have put the data here, the forward rate was nothing but 60. This 60 into 1.10, that became 66. To right hand side 1.10 divided by this 1.02. Same thing comes here. It's 60 right hand side. Spot rate 60 into 1.10, that becomes 66 divided by 1.02. Forward rate is nothing but forward by spot is equal to right hand side 1 plus right hand side divided by 1 plus left hand side into exchange rates will come out. So two things to remember from here. First part is the currency which has a higher interest rate will trade at discount. The currency with the higher interest rate will trade at discount. The currency with the lower interest rate will trade at premium. In this case, if you look at the exchange rate, if you would have calculated, forward rate would have been $1 is equal to rupees 64.71. Exactly same thing come which I have done roughly. What I did was, in the dollar, 1.2% interest will lead to 1.02. 10% interest will become 66. So relationship will be 64.71. Same relationship is given by this IRP. The example which I have taken here, if I would have tried to put here, the $1 is equal to rupees 60. If rate is 0 here, it becomes $1. The rate is 10% here, it becomes 66. So at this rate, there will be no arbitrage whether you go from India to US, US to India. That was exactly 66 which was coming here. Any rate other than 66 will lead to the arbitrage opportunity, whether it is coming to India or going outside India. Exactly means is. So IRP gives you the exchange rate. The currency which has a lower interest rate will trade at a premium. The currency with the higher interest rate will trade at a discount. If IRP fails, then there would arise riskless. Arbitrage is a riskless profit that would arise. Now this process will learn along with the arbitrage only. Let me look at the example here taken on the 14th page. Example, it says spot rate $1 is 60, interest rate 2%, rupee 10%, forward rate bank is quoting. So I am not looking at forward rate bank is quoting. If I apply my IRP, first part will ask, does there arise any arbitrage opportunity? Means there is any arbitrage opportunity or not. First, if I try that if $1 is rupees 60, I am just applying the rough formula. You can apply that forward rate by spot rate. It's 2% rate, 10%. As per us, when we solve this, we should get $1 is equal to rupees 64.71. You apply the formula only, forward rate divided by the spot rate and so on. Now, actual rate appears what? 63.5. Now, arbitrage is there. Since it's an Indian currency, maybe some of you would be comfortable, easily able to identify which country to borrow and which country to spend. As per you, the rate should be what? 64.71. Available what rate? 63.5. Now, there is an arbitrage opportunity because fundamentally as per you, rate should be 64.71, available at 63.5. Now, how would you decide which country to borrow and which country to for example, in this case this was the case done. While going back, it was 110. In this case, it was 94 to 86. So it was not advisable in third case to come to India. Go to US was advisable. First case advisable to come to India, because if you stay back in the US, $1 lakh will remain what? $1 lakh. So first case, come to India, stay back in India, earn the interest. When you go back, it will be $1,10,000. So in first case, it was arbitrage profit when you come to India. Third case, arbitrage profit is when you go to US. Borrow in India 60 lakh, convert at the spot rate, it will become $1 lakh. Go to the US, $1 lakh will remain $1 lakh. When you come back, they'll convert at 70 rupees, that's a 70 lakh. Third case I'm talking about, and you pay the interest at the rate of 10%, that's 66 lakh. Now if you try, if I give you this data here, that as per you the rate should be 64.71, available at what? 63.5. Prima facie, maybe some of you coincidentally can tell me that which country to borrow and which country to invest, but it's a very difficult exercise if you have a different kind of currencies. In exam, what will follow irrespective of the forward rates, what I'll try to do is, I'll try to make my life simpler. Look up please. I'll assume, if the red color I'm using, if this is available with me, if this is the forward rate available with me, I'll assume any one of them interest rate as a missing figure. So when I assume any one interest as a missing figure, it becomes slightly easier for me to understand, rather than comparing 64.71 and 63.5, there could be confusion. In case I compare that available is spot rate, available is forward rate, and let's suppose I assume 2% is dollar, what should be the rate of the rupee? What should be the rate of the rupee if I would have applied IRP theorem? So when I apply calculation of theoretical interest rate of rupee, as per IRP we call it as forward rate by spot rate. If forward rate is 63.5, if spot rate is 60, and I have the dollar rate as 2%, what should be the rupee interest rate? When I solve this, I get rupee interest rate as 7.96. Now as per me, interest rate should be 7.96. Available what? 10. Let's suppose I went to the market and in my mind there was the rupee rate should be 7.96, but they're giving me what? 10. Expensive or cheaper? As per me, the rate should be 7.96, but I went to market and they quoted me rate at what? 10. Expensive. As what do you think, it will be expensive or cheaper? Expensive, because you thought it will be 7.96, where it appearing at what? 10. Expensive item we always sell. That means you invest there. It's always selling of that. So if I invest, that means I can take a call, invest in this currency, automatically borrow in which currency? Dollars. Automatically borrow in dollars. I'm again saying, by looking at these two rates, when you apply IRP normally, spot rate, forward rate, interest rate, and calculate forward rate is not matching with the actual. So what is this 64.71, which should be theoretical as per the formula, and what practically is appearing in the market? 63.5. By looking at them, you can make out there is a arbitrage possibility, but it's difficult to understand which currency to borrow and which currency to invest. It becomes much easier when we assume any of the interest rate as missing. I assumed if rupee interest rate was missing and given to me are this 60, this 63.5 and this 2%, then what should be the rupee interest rate? When I calculated, my rupee interest rate should be equal to 7.96. Then I say, as per me, rate should be 7.96, available at what? 10. It's expensive. I'll invest in which country? Rupee. That means borrow in the opposite currency dollar, invest in rupee. So by looking at interest, irrespective of currencies, you will not get a confusion. Otherwise, when you look at these two rates, first part can be done, but second part becomes slightly technical. You have to take a break, then say 64, 63, what comes, what goes out. It could be slightly confusing. So interest rate I assume missing. I got rupee interest rate 7.96. Rupee interest rate is expensive because it's giving me, for example, 7.96. I assume that would be rate. They're giving me 10%. Instead of borrowing from them, I'll invest in the rupee, borrow in the opposite currency. So it's a 7-step process which becomes a zero period. What I'll do is borrow dollars. Either he'll give you or assume something. Convert in the line chart will tell me what is happening in the zero period. 3 steps are happening in the zero period. Borrow dollars, convert to rupee at spot rate, that's 60 lakh. and invest at the rate of 10 percentage and forward contract to be done, so that when the rupee is realized at the end, you have to convert that to dollar and give it back the dollars. So zero period is borrow in dollars, in convert to the rupee at spot rate, invest for a 12 months time, enter into forward contract. Fourth step would be realize this rupee along with interest, then convert this, what was the bank quoting, this agreement you've done in the zero period at 63.5, in hand will come 103,937, repay dollar borrowing along with the interest, 1 lakh dollar plus 2, 102. So you realized 103,937, paid back 102, arbitrage profit is 1937. Again I'm saying what has to be done is, when he says does there arise any arbitrage opportunity, if only this question comes, then you can calculate the forward rate. If the forward rates are not matching with the actual forward rate, there is arbitrage opportunity. But when he says you have to show which process to borrow and invest, in that case assume one of the interest rate missing, any of the interest rate missing, will get net decision as same only. In this case we got that rupee was 7.96 available at 10 percentage, it's a costly, I'll invest in the rupee. Process would be borrow in the dollar, convert in the zero period, these are 3 steps, convert to rupee at spot rate, invest and do the forward agreement. Fourth step, realize rupee along with the interest. Fifth is convert that realized amount, what rate you agreed here, that bank was quoting 63.5, repay rupee loan along with the interest, and balance of realization and repaid is nothing but arbitrage profit. Same thing I suppose I would have given you in the wordings what you have to write. The diagrammatical presentation is only to understand the flow, and what have to done in zero period, what has to be done at the end of the year. So it has to basically, there exists arbitrage opportunity since or because interest rate is not equal, the actual interest rate is not equal to theoretical interest rate. Since actual interest rate 10% is greater than theoretical interest rate, we say interest rate is overvalued. Hence strategy should be invest in rupee and automatically borrow in the second currency, that's dollar. The arbitrage process would be borrow dollar 1 lakh, convert dollar 1 lakh into rupee at what rate? What rate? Invest for 12 months and equivalent amount would be 60. That is happening in what period? Zero period. Enter into a forward contract at 12 month, $1.63.5. This is most important part. If you do not do, then you cannot create arbitrage. An arbitrager is a person who will borrow from one side and invest second side. He does not bring anything from home. He just uses the data of mispricing in the market and utilizes for his benefit. That's it. So arbitrage is a person who uses the data in such a way that there is a mispricing in the market, and because of that he is able to earn something. So he'll enter into 63.5. After 12 months, realize rupee investment along with interest 66 lakh, and then convert back to this repay dollar loan and arbitrage profit. Quickly look at the process. Put these slides, look at please. Arbitrage process. The same will be using for money market also. Same process. Go through the process please. The same process will be using for money market. Instead of rupee interest rate, you could have assumed the dollar interest rate as missing also. The net decision would not change. The decision would come same. What has been assumed is one of the interest rate is missing, so comparing interest rate becomes much easier rather than comparing the forward rates, especially when you have different currencies. Same currency is slightly possible whether we go to the rupee, we borrow in the rupee, we invest in the rupee, but if there is different currency, the things can be slightly difficult which comes out. An exam you will have to write the process, that why it happens, because generally it comes for 8 marks question. I think we have in the book notes Number 6. Question number 6 you can try if you have. Question number 6 you can try out. The spot rate is rupees 15 per euro. I don't know which time it is here per euro. 15.2 per euro. 8% per annum in India. Rate 5.8. Germany. Assume you can borrow as much as 15 lakh. That means if you do the borrowing in rupee, it's 15 lakh. If you do the borrowing in euro, it's 1 lakh. Whether interest rate parity is currently holding. Any ways you can calculate, whether you apply IRP to calculate the forward rate. If your forward rate is not matching 15.2, there is arbitrage opportunity. Or you can imagine, if spot rate is given, if forward rate is given, and we can assume that if interest rate of Germany is given, only make sure the rates are per annum. You have to reverse calculate the rates. So you can assume into 3 by 2 and then look at 3 by 12 and then look at the comparison purpose. And how would you carry out covered interest arbitrage? That's a arbitrage only, basically buying and borrowing in months and selling in the investing in the second and entering into forward contract. Any of the currencies interest rate you can assume as missing of your choice. Just check these steps so that you get comfortable. Right? We have, if spot rate is given 15, actual 3 months rates are 15.2, interest rate is 8% per annum, and this is 5.8. Calculation of theoretical interest rate of rupee as per IRP. Forward rate by spot is equal to 1 plus rupee interest rate divided by 1 plus euro. We assume if 15.2 is given, if 15 is given, and if 5.8 into 3 by 12, because 3 months rates. What should be rupee interest rate? When I solve, you can check the calculations, it should be right. Rupee comes 2.803 for 3 months. Rupee interest rate per annum is 11.21. Now how do I root? First part he asks, is there any arbitrage? We say IRP theorem is not holding because actual interest rate 8% is not equal to theoretical. As per you, rate should be 11.21. Available at what rate? It's cheaper. Means if you thought you'll borrow the money 11.21, you were ready, but rate available at what? 8%. Since theoretical interest rate is 11.21, actual interest rate is 8, rupee loan is undervalued. Strategy should be borrow in rupee, invest in what? Euro. 3 steps would be 0 period, borrow rupee, convert to the euro, enter into forward rate. After 3 months time, realize euro investment, convert back rupee, repay rupee loan, and difference would be the arbitrage profit. Quickly check the answer. So I've written in the line chart only instead of dictating that sentences. In exam, do not show the line chart. It only tells you what is happening, what time period. Try out, please. Once you decide which currency to borrow in the rupee 15 lakh, convert 15 lakh in euro at spot rate, and 3 months euro equivalent is 1 lakh. Enter into forward contract, sell euro at a forward rate. Now what will happen is realize euro investment along with what? Interest. 1 lakh into this euro 101,450. Convert to rupee at forward rate. It's a fifth step. 15.2 rate was agreed in the zero period only. It gives you 15,42,040, and then repay rupee loan along with what? Interest. That is 15 lakh 30,000. Difference of these two, 15 lakh 30,000. Difference of 15 lakh 30,000 and 15 lakh 42,040 is nothing but arbitrage. Just try the steps number so that you are comfortable. How do you decide? The question which has come 2 times in the exam recently came. Same type of a question. I think slightly figures were different. It came long back also, 34th. In this you can assume 1 lakh or 1000 quantity, whatever number you have. Try on your own quickly. Canadian dollar and DM please. Canadian dollar and DM. I'll tell you the area of a mistake. 34th question. Try out quickly. Try question number 34th. I'll tell you what exactly has to be done here. Done. I'll just tell you the area of a mistake which will be there. First step will not have a problem. Go back. Slide number 18 I am on. 34. Spot rate is given 1 DM in Canadian dollar 0.665. 3 months is given 1 DM Canadian 0.670. Interest rate DM 7%. Canadian dollar 9% per annum. Calculation of theoretical interest rate of Canadian dollar. You can assume anything. I have assumed missing out as Canadian dollar. This means if I have availability of 1, 2 and 3. As per IRP we say forward rate 0.670 divided by 0.675 is equal to 1 plus Canadian dollar interest rate, and when we recalculate get rate of the Canadian dollar per annum. 3 months is 2.515. Per annum we end up getting is 10.06. Appearing in the market at 9. That means the Canadian dollar is cheaper. Borrow in Canadian dollar. First we say there exists arbitrage opportunity because actual interest rate of Canadian dollar 9% is not equal to theoretical interest rate. Then since actual interest rate 9% is less than theoretical interest rate of 10.06, the interest rate is undervalued. Hence the strategy should be borrow in Canadian dollar, invest in what? DM. So 0 period you borrow Canadian dollar, anything you can assume. I have assumed 1 lakh here, you can assume 1000 or he will give you. Recent exam when question came, I think he gave 1 lakh or 1000. So 1 lakh I borrowed, convert to DM at spot rate. Now when you are converting DM at spot rate, be careful. Generally in a hurry, student is not able to identify the rate. Since Canadian dollar is a confirmed currency and keep on the left hand side, when we go left to right, we will multiply. That means when you are converting 1 lakh this into the DM, Canadian dollar was a confirmed currency. When you convert and invest for 3 months, you go left to right and you multiply, that gives you 1,53,76. Then enter into what contract? Forward contract. This whatever you have invested in which country? DM. Realize with interest. That will be DM 153,008 and convert to Canadian dollar. Now confirmed currency is DM. DM is on the left hand side. Rupee will not give you trouble because directly, indirectly, multiply, divide, you know, knowingly, unknowingly whether it has to be divide or multiply. But at least for any other currency, make sure that whatever is confirmed currency, keep on left hand side. Left to right is multiply. So after 3 months when you have DM, it's 153,008, convert to Canadian dollar, 153,008 into 0.670, you get what? 102,515. Repay 1 lakh plus the interest, it becomes Canadian dollar 102,250. Difference of this and this is the arbitrage profit. Objective is not the amount here. Some of you might wonder, sir, if I take 1000, amount will come very less. The objective is not the amount, it's the objective is the process to be able to do it. In case, if let's suppose when you go back home today, if you feel like, then apply the IRP theory and calculate a forward rate. Your forward rate would not match with this actual forward rate, and try to think a process. It will be very cumbersome exercise. Whereas when we look at the interest, things becomes easier irrespective of any currency under the sun. We have, when I say as per me the rate should be 10.06, I am not even looking at the currency, and the rate available is what? 9. If cheaper available, I will borrow automatically, then I see this currency. Otherwise I do not even see this currency. Then I will see that currency borrowing. So make sure that when you are applying the arbitrage, use process of the missing figure as one of the interest rates, any interest rates of choice. This was IRP. Second theory which is based is on the purchasing power parity theorem, although there could be slightly lengthy discussion on that if we require. It is absolute or a relative, proportion, etc. But what comes from the formula perspective, I'll just do that only. So we have purchasing power parity theorem, PPP, purchasing power parity theorem. It is based on the inflation. In fact, inflation and interest numbers are interchangeably used. Interest rate changes because of the change in the inflation rates only. So instead of based on the interest rate, this is based on the inflation. So what is PPP? Purchasing power parity. Parity is equality. Based on the inflation numbers, we have the expected or estimated spot rate ESR divided by spot rate. So instead of forward rate, we have ESR 1 plus rupee inflation rate, or 1 plus, in fact you can say right hand side inflation rate, 1 plus right hand side inflation divided by 1 plus left hand side inflation. Exactly same theory. The FR forward rate is substituted by the ESR, expected or estimated spot rate. This theory is based on the inflation. In fact, both of them are interchangeably used. The IFE effect, if we go back and check the Fisher effect, he says the inflation is often, interest rates are often associated with the inflation rate. The movement in the inflation rate leads to changes in the interest, and that is exactly what happens. For example, if the inflation remains high, the central banks of the respective countries will keep the interest rates high. So it's a vicious circle. Only problem is there's something called real and nominal that could create slightly problem. Otherwise, you can assume the ESR, expected spot rate, forward rate, both are same. And if an exam, the question comes, by chance a question comes in which you have to show the symmetry between them, then make sure that symmetry can be shown, that since both of them are interrelated theory, whatever we get as per the IRP, same thing we get as per the PPP, although there is logically some different. There is some difference because the interest rate is a nominal interest rates, which includes the real effect. If the real rate is assumed to be same between across the countries, we say sometime that the interest rate movement comes because of the inflation only. So what basically I mean to tell you is, for example, there is something called a real return, there is something called a, because of inflation. Interest rate is a nominal basically in nature. If let's suppose interest rate is 10 percentage and real return is 2 percentage, the rest effect could be because of the inflation 8 percentage. So if second country I assume, let's suppose US, it's a 4 percentage, the real return is 2 and the inflation is 2. So basically difference of this is 6 percentage, difference this is 6. So it's roughly used sometime interchangeably, that whatever answer we get from the IRP, same type of answer we can get from the PPP. But technically it is difference, because when you say 1 plus right hand side divided by 1 plus left hand side, if I do 1.10 divided by 1.04, if these were the two countries, let's suppose this was rupee and this was dollar, and if this is US, let's suppose, so 1.08 divided by 1.02, technically they are not same, but for the purpose of sometime rough work, they can be assumed as a same. What I'll do is I'll try to do a question with you. Instead of going into the lot of theory of this part, I'll show you that how the question framing can be done, which I think has not been done in the exam till now. So there could be possibility, something they can do is they can interrelate both the theories. When they relate both the theories, when you go back home, read the Fisher effect, you'll come to know, as per the Fisher, he'll explain that the interest rates are often attached with the movement of the inflation factors and so on. He'll speak on something of that sort. You'll be able to arrive at some number. Let me first look at the normal question only. So as per the PPP, purchasing power parity, inflation numbers we have ESR by SR is equal to 1 plus right hand side inflation divided by 1 plus left hand side inflation. Everything is same. Instead of the interest rate, this is attached with the inflation factor. Let me look at the question first of this case. Question number, I think, 49. Question came recently also. 49. Quickly try it out, please. Try out question number 49 once. Says the rate of inflation in India is 8% per annum, US is 4%, current spot rate is USD 46. What will be the expected rate after 1 year and 4 years? 1 year you add the 1 year effect, 4 years will add the 4 years effect. Not given. 49. $1 is given as what? Rupees 46. What is given spot rate? 46. Since inflation is as per, it's asking to calculate the expected rate, that's expected spot rate or estimated spot rate after 1 year. We can calculate. The formula would be expected spot rate by spot rate is 1 plus RHS currency inflation rate, whatever is the currency, divide by. And one thing is for sure, the country which has a higher inflation will trade at discount. ESR, I don't know. 1 year we are calculating. 1 year. 1 year inflation will take. Spot rate is what is? Rate is 1.28 divided by 1 point. ESR would be equal to 46 to 1.08 divided by 1 point. Implies $1 equal to 47.77 or 47. One part. Now second part he is saying how many years? 4th year. The 4th year we say ESR divided by what? 46 equal to 1.08 par divided by 1 point. R 1.0 to the power 4 is how much? 1 point divided by how much do we get? Done. Now let me try to look at a data in which we'll try to compare both of them. Question which has not been asked could be a possibility they might ask you. What it means is, let's suppose I have the US, I have India as a rupee, and the interest rate in the US is 4%. Interest rate in India is 8%. Let's suppose. If we apply IRP, we'll apply 1.08 right hand side divided by what? 1.04. it is assumed that real return of two economies would be same. Real return is basically because of the efficiency which comes out. So if the real return of two economies are same, let's suppose this is earning 2 and this is also earning 2. It's basically any machine when it's get upgraded, whether it's India, US, Germany, the output would be upgraded everywhere. So the price which increases, because that is called real return. So if the two countries have same real return expectation, then balance differences because of the inflation. We call it as 2% and 6%. Ideally, when we apply purchasing power parity, it's 1.06 divided by 1.02. Technically, they would not give you same, but we can assume roughly as the difference of these two is 4 and difference of these two is 4. So roughly they can be assumed they'll give you both answer. They'll give you roughly both same, and there could be a possibility any examiner can attach both of them. This is basically based on the principle, if the real return expected from the two countries or currencies is same, then the difference in the interest rates is justified by the difference in the inflation rates which comes out. So based on that, I am picking up a question, small question, which we can try. Up a small question from which you will not have. Let me from in module, which could be a possibility if any examiner who has read the theory well, there could be possibility he can frame up a question which will link both of them. And look at my notes only. 7th number question. Money and foreign exchange markets in New York and Tokyo are very efficient. You have the following information: Tokyo, New York, spot rate dollar this per yen and dollar $1 Japanese yen. If you try to convert, they'll be roughly same. It is 0.00853. It will be 0.00852 something or 5 something. So it's a 0.00853. Both are same. Risk-free rates are given, both of them. Expected inflation in the US is 3.33 if purchasing power parity holds. What is the expected inflation rate in Japan? Ideally, how do we solve this? Let's suppose if we assume, if I pick up any country I can pick up. Let's suppose I picked up this country here. So this is my 1 Japanese yen. 1 yen is $0.00853 spot rate. So if I apply the purchase in the PPP, the formula would be ESR divided by SR is equal to 1 plus right hand side is dollar inflation rate divided by what? 1 plus yen inflation rate. And he's asking to calculate inflation rate in what? Japan. That means this we need to calculate. Second part we need to calculate. We have 3.33. This is available with us. We have spot rate. We do not have what? ESR. Now since we do not have ESR, the way of solving this question becomes is, if this is my spot rate and these two are my interest rates, these two are my interest rate, I'll calculate using the forward rate. That forward rate would be assumed as the expected spot rate. That forward rate would be assumed as expected spot rate, and then I'll get this. I know this, and I can reverse calculate. So once again, since I need to calculate the expected inflation rate in Japan, we do not know the expected rate in inflation in Japan. This is missing figure. Since we know the dollar inflation, it's okay. Spot rate we know, ESR we don't know. Since I do not know the ESR, what I'll do is, using my this figure, using my risk-free rate, using my this rate, I'll calculate the forward rate. That forward rate would be assumed as, or would be same as what? ESR, and then ESR, SR and inflation rate known, then I can reverse. So I have this is yen and this is what? US. So basically I'll have forward rate divided by spot rate is 0.0085 is equal to right hand side is dollar. So dollar would be 1.056 divided by 1.035. Forward rate I'll get 1 yen is 1 yen is equal to how many dollars? 0.00872 0.007 0.00872. So if I know my forward rate is known, basically this way of doing it, Tokyo, when I stand in the Tokyo, we say if I'm standing in Tokyo, it is available, these two are available, my forward rate would be equal to 1 yen is $0.00872, FR would be equal to SR, and then using my IRP I can calculate that if this is available, now this is available, I can reverse calculate the, I'll show you the data, quickly try out, and then I show you the answer to cross check. Try once from your side. First calculate the forward rate, assume that forward rate as ESR, and then calculate. Number comes for me is 0.0072. Then I apply my purchasing power parity. Basically, there is a link between this and this two. The possibility they can set this kind of a linkage between. So basically, using a IRP, we calculated forward rate. Using that rate, we have reverse calculated inflation. Move forward. So next we are moving is to the foreign exchange risk management tool. One of them, forward contract, we have already learnt knowingly, unknowingly, and moving. If I move foreign exchange risk management tool, there are there is forward contract, currency options, currency futures, money market, and then we have currency swap. Currency futures and options will do after derivatives. I'll pick up money market operation, which has similar link with the arbitrage process. This is actually one of the foreign exchange risk management tools. The objective of this topic is foreign exchange risk management tools is make sure that the importer wants that he should know with certainty what would be his costing or rupee required or a home currency required to buy the foreign currency. Exporter would like to know what would be his inflow. They do not want to maximize, means given the some techniques they want to maximize at a point of a time. So what they want is money market, using whether a money market operation, forward contract, currency swap, or maybe by using the currency futures and options. They want to make sure that they get the desired amount and there should be no fluctuation in that going forward. When we say a money market operation, we have two parties here. One is importer and second is exporter. Exporter originality is he will receive foreign currency and will sell foreign currency. Importer will need foreign currency and buy foreign currency. That nomenclature will not forget. I have taken a small data example to understand the flow, then we move to the question of effective topic. Exporter's angle. Exporter is expected to receive $1 lakh after 1 year. Spot rate is available at 70, interest rate 4%, 10%. 12-month forward rate quoted by bank is 72.5. Which option is better, forward contract or money market? The same question could have been there for arbitrage also, because if you calculate the rate 70 into 1.10 divided by 1.04, that would not be equal to 72.5. So the same question he can create. So do not worry on that front, sir. Why he is not creating arbitrage? Arbitrager looking at this data will create an arbitrage opportunity. The businessman who has some inflow or outflow of the currency will use this data to make sure he maximizes his inflow and minimizes his outflow. So if exporter will receive a foreign currency 1 lakh and enters into forward contract, the rupee equivalent inflow would be equal to 72 lakh 50,000. So there is no doubt on that. He'll receive 72 lakh 50,000. 1 lakh into 72.5. Now under money market operation, how to think, sir? What has to be done? The way of thinking you have to create. Now look at this data point here, please. 0 period, and we are assuming what? 12 months time period. Exporter will receive foreign currency or will need foreign currency? Receive foreign currency. This is the situation of the exporter. Dollar inflow will come after 12 months. Now it is same as, let's suppose you expect your stipend salary to come at the end of the month, and you know that salary would come at the end of the month. There will be inflow of rupee. You can start spending today. You can do some spending today, and you will spend today or buy something on EMI such that whatever you buy plus interest on it should be equal to whatever money you received after a period of a time. Exactly same thing exporter will do. He knows he'll be receiving what? $1 lakh. Now what he'll do is, first step, although we write first step, but by looking at the end result, if I know I'll be receiving $1 lakh, then I do my calculation at home. Instead of waiting for 12 months, I'll borrow in dollars X amount such that this X plus interest on dollars should be equal to $1 lakh. It's outflow. Now this inflow and outflow will get cancelled. This is called hedging. No matter what the rate becomes after 12 months time, whether it's 50, 70, 80, 90, 75, his inflow will get cancelled with the outflow. That is the objective of the process. Now how he decided to borrow in the 0 period? Since I know there is an inflow, so if I know there will be some income at the end of the month, I can start spending today. I'll spend such an amount so that spending plus interest on it, I should be able to meet out whatever I receive at the end of the month. So he'll borrow in dollars such an amount so that borrowing plus interest on it becomes equal to what? $1 lakh. So then he'll do what? The borrowing which he has done, he'll convert at the rate spot rate to local currency, let's suppose in rupees, and then rupee he'll invest in India. He'll earn interest on rupee here, and at the end he will know that this is confirmed rupee which he will have in hand, and whatever confirmed rupee he has have in hand, this he can compare with different options. He can compare with the forward contract, he can compare with the currency option, he can compare with the futures option, etc. And whichever gives him the higher inflow, he can decide to maintain that. Understand the flow once again, please. The objective was whatever is expected to be received, borrow in zero period equivalent amount such that it's basically present value of the future inflows. If I tell you very frankly, so if I know I'll be receiving 1 lakh in zero period, I'll discount by the interest rate. I'll know what is my present value of the borrowing. That borrowing plus interest on it should be able to match your inflows and outflow. This third step is called the hedging, or your basically risk management tool, in which one hand inflow will come and outflow will take place. So in my process, what I'll do is, since there was an inflow expected, by looking at this, I'll do borrow in dollars such an amount so that borrowing plus interest on it becomes equal to 1 lakh. Sir, what happens? No matter what the rate becomes, the risk management tool has been applied, because inflow will come in dollar, outflow will happen in what? Dollars. So it automatically gets what? Cancelled out. Inflow outflow gets cancelled out. Convert to rupee at what rate? What rate? So 96,154 into 70, that gives you 67,30,780, and plus 10% interest, you receive what? 74,03,858. Money market was giving you what? 72,50,000. So whichever option gives you higher, select that option. When writing a step, you write the steps accordingly. Borrow such an amount of dollars so that borrowing plus interest on it becomes equal to $1 lakh to be received after 1 year. Although you look at the third step and then make a calculation. If it's a inflow, you borrow. If it's a outflow, you invest today. So that will do in the importer's case. So it was looking at third step. I have taken the first step. So it is nothing but 1 lakh divided by 1.04, 96,154. Convert to rupee at spot rate, because I want to see how much amount I have. Practical life, will he convert or not? We do not know. Will he convert or not? We do not know. Maybe he'll borrow and convert in rupee and then utilize for some purpose. But for the exam, since I have to take a call, how much would be there in the hand in rupee terms? So I have to accordingly show the process. So it will be, you borrow, convert in rupee, invest in rupee, and the borrowing which you have done the first step will be repaid from the receipt in the third step. That calls, you have managed your risk. And fourth step is, you know your local currency was rupee, realize along with this whichever gives you higher option. Forward contract was giving you 72,50,000, and this option is giving you what? 74,03,858. So money market operation is better as leads to higher cash inflow. Quickly go through the process. Then we look at the question. It's exactly because of the arbitrage philosophy only. Same question could have been given for the arbitrage. It is mismatch of the interest rate and the forward rate quoted by the bank. Because of this mismatch, this kind of a scenario is appearing. Otherwise, there was no reason of doing such type of question. To have 72.5, first give you what? 72 lakh thousand. And money market operation gives you 74,03,858. Similarly, let me look at the importer's angle also. I've taken a data for the importer angle. Importer will need a foreign currency and he will buy a foreign currency. Now, if I try to look at the money market operation from the importer angle, it is as good as you need some money for buy a house. After 2 years, you need buy something you have liked, but you don't have the money at one go. So what you start doing is, if let's suppose you know that after 12 months you need dollar 1 lakh, your outflow, need dollar 1 lakh. In 0 period, you'll start doing what? Invest in dollars such an amount so that investment plus interest on it becomes equal to what? Dollar 1 lakh. If you know that you need the money after point of a time, in 0 period you start investing. If you know you'll receive, in 0 period you can start spending. For example, you know that after becoming chartered accountant, the marriage will take place, you need some money for your function. So accordingly, some of you might have started doing planning, or your parents might have started doing planning. They would not have done in the dollars, they would be doing in the local currency, but they'll be doing interest plus this, or the gold plus this will become equal to this much, and this much will be spending. That's how the planning takes place. And this you have done in a number of things, whether you buy the machine, whether you buy something else. Only difference is they do in the local currency, so it does not give you a trouble. For example, after 5 years, company needs to buy some machine, so they start making some fund in the 0 period, such that the fund plus interest fund becomes equal to end period. Exactly same philosophy works for the importer. Only problem is, importer, since he is associating himself with the foreign currency, he has to make sure the flow of the foreign currency should be appropriate. If it's an outflow which is required, so 0 period has to be investment. Now the problem is, the question arises, how can do the investment? If he would have had the money, you could have paid in the 0 period instead of investing. So what he'll do is, he'll actually, this I write as a first step, but in the 0 period, second step actually is the first step. He takes a loan in the rupee. So before knowing how much to invest, he cannot know how much loan he will take in the local currency to buy this amount. He'll not borrow in the dollars. He'll the loan he'll take in rupee. By taking a loan, he'll buy in the dollars and invest in the dollars. To know how much dollar to be invested, I need to know it should equal to 1 lakh. So once I know this, I will take a loan. Once I've taken a loan, this will be repaid along with the interest, and I know this is my certain outflow, no matter what exchange rate happens after 12 months time. When we use this language, I'm hardly concerned, or it's immaterial for me. Whatever the exchange rate becomes after 12 months of a time, my inflow would be equal to what? Outflow. So in that scenario, we call it as you have properly hedged yourself. That is exactly what is happening. In this case, if I look at the flow, slides you read with me only, because I have big slides such a way I can only read, or those who are reading with me, they can only read. Importer needs to make a payment of $1 lakh after 12 months. Spot rate $1.60, interest rate $1 4%, and fees 10. Forward rate $1.65. That means if you go for the forward contract, you will require 65 lakh rupees to buy dollar what? 1 lakh. This is the requirement. Now let's suppose you go for the money market operation. So I have made the diagram and the notes on the same page. This is my outflow, and the arrow tells me basically first step I am creating is for this third step. If I need $1 lakh in 0 period, I'll invest such an amount of dollar so that investment plus interest on it becomes equal to what? 1 lakh. It is nothing but present value of the future cash flow. Present value of the future cash flow. So 1 lakh divided by 1.04, 96,154. That means 96,154 plus interest on it will become equal to 1 lakh. And what you have in box here, this showed your management tool irrespective of the interest rate. Sir, today the spot rate is 60. What if the rate becomes 55, whereas you have hedged yourself? If the 55 becomes, you could have saved something, the outflow. In case you are confident that rate would be in your favor, then there is no need to hedge yourself. For example, if exam you go and you know the question would come on the money market only, rest of the forex chapter leave. If you know, in the derivative, question will come on the futures only, option market leave. So if you are confirmed, then leave. Similarly, if someone of you start assuming, sir, if the rate would become 50, rate would become 55, he would have made a gain, whereas we have hedged himself. Hedging does not mean that it will give you the save you from the gain you could have made. Hedging is, you are certain you can sleep nicely at home no matter what happens. You have made sure that your outflow in the rupee term would not exceed. Hedging is different from the risk you take. If you think that yes, 50 rate will become 55, rate will become what is present at 60, then there is no need to do hedging, or there is no need to create any kind of a risk management tool application. The objective is, if I need an outflow, I'll make saving here. It is as same as, if you know you'll earn so much of a salary, no need to save today, I'll be able to take care of my expenses, whether it's a marriage function, whether it's a house, whether it's a bike, car, anything, then no one would be saving in the zero period. But it does not happen. No matter what kind of a person is there, he'll always have a fear, my salary, my income would not support what is my goal after 5 years. Even the mutual fund ad you see, they say the same thing. Invest in mutual fund depending upon your goal, and we never know when it becomes a football, that's the other way around, but they always say the same thing. You respect that, keep investing, keep investing. Safest investment, to be very frank, just because the topic came this way, is one of the PPFs, which I think this government is not very keen to continue for a long time. I don't know why, because the interest rates is kept below par. Otherwise, that was such an instrument which I have seen over the last 15-20 years, my family, that investment happens, you get a tax saving, and at the end of 15 years you get such an amount. You can, means for example, if you are, as of now, if you would have started 5 years back, you never realize in the next 10 years, 15-year period, how much money it becomes. One of the safest tool we used to have. But actually, I think the economy is moving into a consumption economy now, that you earn, spend, earn, spend. When the cycle happens, the economy grows. That's why I think two slabs have come. Anyhow, the topic came in mind, but the investment purpose is basically, if you need some money, start investing in the zero period, invest such an amount so that investment plus interest on it becomes equal to this. This is hedging. Take a loan. Actually, this second step should have come first, but I do not know how to write second step, how much loan to take, unless until I know how much to invest. So it will be spot rate and repay this. Exactly same thing I have done in the wordings here. So diagram just helped me the flow of the topic, that if I need something here, zero period, I'll do something. Accordingly, I'll borrow and I'll take a loan in this currency and repay. So my steps are, invest in dollars such an amount so that investment plus interest on becomes equal to 1 lakh after 12 months, and take a loan in rupees to buy 96. This is the loan. After 12 months, step will be realize dollar and along with interest and pay. You do not have to show any calculation, because mathematically, automatically same will come. You have done this calculation here only. Repay rupee loan along with the, quickly check it out. Quickly check it out. Once you have checked this slide, then let's try question number 43. Then let's try question number 4343. A Limited of UK has imported, it's an importer case. A Limited of UK has importer case. Chemical worth USD 364,897 from one of the US suppliers. Amount is payable in 6 months time. Relevant spot and forward rates are, it's a 1 pound is equal to dollar given, 1 pound is equal to dollar 6 months after given. Rates in the money market, the interest rates are per annum if nothing is said. One exception is there in the currency derivatives, otherwise rates are always per annum no matter how they write. This part we are not reading, this will do after currency options. Forward contract and money market cover. Now forward contract, let me, whenever we do this part, always write the rates. If it is given 1 pound is equal to dollar something, always write $1 is equal to pound, else you will be in a area of making a mistake. Reason being, sir, because dollar is my confirmed currency here, and dollar has to be on what side? Left hand side. He is a importer, exporter, importer. He will need to buy or sell. By importer will buy, I will do what? Sell. So I'll be applying, I will be looking at this rate and then do what? The ask rate. Do not be in a hurry. If you look at the answer from your the institute side, you directly do it. They're smart enough to know it. From my side, simply whatever currency is confirmed, put on the left hand side, it's a dollar. Left to right will multiply. Since he is a importer, so what we'll be doing is, if this is 1.5445, so I think the reverse will come this way. Automatically this will be used. When I look at this part here, always have a habit of converting the rates in such a way. What we do is, UK was an importer. Since UK is an importer, he will need $364,897. I have spot rate pound given dollar. Dollar is a confirmed currency, so I put my dollar on the left hand side. 6 months forward rate, 1 pound given. Dollar is a confirmed currency, I put my dollar on the left hand side. And forward contract is basically, first I look at 6 months forward rate because I am going for a forward contract, and then confirmed currency is dollar. I look at dollar, and since he is an importer, he will need to buy I would do what? Sell. The ask rate is applied. Ask rate, bid rate and ask rate can be for pound, bid rate and ask rate can be for dollar. Since you need the rate for dollar, so dollar has to be a chocolate. To keep on left hand side, this rate would come. Now for the money market operation, I know, if diagrammatically, let me not see the answer and try to put it here. I know after 6 months, I need how many dollars? 364,897. Inflow or outflow? Outflow. If it's an outflow, that means I need to create something so that I get what? Inflow. It means 0 period, I'll do what? Invest in dollars. Invest in dollars such an amount so that investment plus interest on it. And make sure when you're looking at the interest, it's a deposit rate. There are 2 rates given, it's a deposit rate. And rate will be per annum if nothing is mentioned. One exception your institute gives, which I'll tell you. I think we might have that in currency derivatives. Otherwise, rates are per annum. It's a 4.5, I think, into 6 by 12. And once you know this investment, this you will buy. You will not borrow. Please understand why you will not borrow in dollar. Because if you borrow in dollar, your outstanding liability in the dollar would be still there. Because when you invest in dollar, this dollar inflow will get cancelled out here. And if by chance you would have borrowed, then what is the use borrowing, investing in dollars? You will end up paying interest only. So it's a buy dollars, taking loan in which currency? Pound. That means once you have confirmed currency dollar, the dollar would be kept on what side? Left side. 0 period you are buying, so left to right you go, apply what rate? Ask rate. This rate would be. So rates, be careful because this will become challenging when we do cancellation. A trouble comes in the cancellation. The exporter, sometime exporter original agreement, reverse agreement. So you should be very comfortable. Customer is buying which currency? Dollar, or borrowing dollar. So Dollar would be kept on the left hand side. I have this part which realized dollar investment along with interest. That is third step. Using this step, I create my 0 period step. Invest in dollars such an amount so that investment plus interest on it becomes equal to 348.97. See the calculation and accordingly take a loan in the pound terms. A loan in the pound terms. Okay, look at that. Get comfortable with the flow please, because cancellation will require slightly reverse of what we are doing here. Just get the flow of it. Few things you'll have to remember is you cannot forget your basic parts because they'll start coming at the end. I think a couple of questions. Left to right, when we go, it's always multiply. Left side is the confirmed currency. It's always, and quotations are from my point of view as of now, because we are dealing with the customer. You can think from your perspective. Importer will buy. If you buy, I will sell. So I am selling. Rate is from my point of view. I am applying a ask rate. If you were exporter, you were selling, I was buying, I will apply bid rate. Now the language is very weird when I say a bid rate and ask rate. The bid and ask rate can be for dollar also, can be for pound also, can be for rupee also. For what we need bid and ask rate, that has to be clear to you. So whichever currency is confirmed, it says buy $1 lakh, so you have to find bid and ask rate for the dollar. If it says 1 lakh rupee, you have to know the rupee on the left hand side, right hand side becomes this. Things becomes easier for you to look at the question. This was importer's angle. Now next part can do theory we can do, and then we can cover types of accounts. Types of accounts. Practical has come once, that came along with the theory, but there could be a possibility they can give you the practicals. Types of accounts. Nostro, Vostro, Loro. Nostro is our account with you, when it means an account opened by an Indian bank with the bank outside India. SBI opens a dollar account with the Citibank of US in US. So it's called a Nostro, my account with you. Your account with us. The same thing if the Citibank will call, they'll say you have your account with us. If in India we are there, we'll say it means an account opened by a foreign bank with the Indian bank. Basically, it does not mean anything. If I am calling it as Nostro, our account with you, they'll be calling it as what? Vostro. Husband is calling wife, wife is calling husband. Reverse way only. How do you happen? Loro, third party saying their husband wife. So that becomes a Loro account. Loro is nothing but a third party relationship, their account with them. SBI has dollar account with the Citibank of US in US. When PNB refers to such a relationship in any of the correspondence, it's known as Loro. Actually, what happens practically? For example, The SBI has dollar account in the US. PNB wants some money and PNB says SBI, I'll make you the payment. You advise the Citibank, they can give you some money in the dollar. So PNB directly has no relationship. PNB will get some amount from the dollars US and they'll make a payment to SBI. SBI will settle with the US. It would be a cross currency basically. If I say Loro is nothing but a cross currency relationship. Nostro is a direct relationship. My account with you and your account with me is a direct relationship which we can have. And third party is doing kind of interaction because of the association with two other banks. We call it as a Loro relationship. In exam, whether he uses a Nostro word, Vostro, Loro, no matter what word he uses, your focus should be only on one thing. What is a confirmed currency and what does he want to do with the confirmed currency? For example, he says, credit my Nostro account with this money, credit my Vostro account with this money. You forget all the languages in between. Figure out what is a confirmed currency, then figure out whether you are buying that currency or selling that currency. So let's suppose he says $1 lakh has to be deposited in some account, etc. For me, rest of the languages are immaterial. $1 lakh is confirmed currency. Since I am buying $1 lakh, dollar on the left hand side, left to right, I'll do what? Multiply, and accordingly I'll deposit the second currency in their account. That's it. If Loro relationship come, it's a cross currency. You have to identify which two currency relationship has to be found, and then using different two currencies you find a cross currency relationship. So let me look at the question, because if this topic comes it might confuse you. Loro, Nostro, Vostro, etc. Accordingly you do it. Let's read this. Jerry once please. Let me look at the practicals. Number 5050. It says an Indian bank wants to fund their Nostro account with US correspondence bank by $5 lakh. Now I don't know what they want to fund or not. They want to fund, that means they want to buy bank. They want to buy what? Dollar using what? INR. So for me it's as good as buying of nothing but dollars. The language is, let me read the language also. Indian bank want to fund their Nostro account with the US correspondence bank by $5 lakh against INR when the interbank rate is 47.20. The way of writing this is 47.20, 47.50. The deal is struck and the overseas bank's Vostro account that is being maintained by the Indian bank will be credited by. So basically what is happening actually, I have an account in the dollars. I say deposit $5 lakh in my account. They will say we have account with you. You deposit rupee in our account. Basically my account is in the US. Same, they will have the account rupee with me also. They say deposit rupee in our account and will deposit what? Dollar. If I leave this language, I'll show you what you have to write in the exam. If I leave everything from here, I'll just say I need to buy what? Dollars. Dollar on the left hand side. Buying of a dollar is as good as buying, and don't get confused please. Now it's a relationship of bank and bank, so interbank rate has come. So its language is from the second bank point of view only. So I am a customer. So I am asking now basically what rate to apply? Ask rate only. Do not get confused, sir. He is a bank, he should apply bid rate. It's not so. It's, if you are asking me, it's a ask rate. If I am asking someone else, it's still ask rate. And remember this, because otherwise in cancellation we'll face a problem. If you are asking me, it's a adjustment of a margin. If I am asking, it's a direct relationship. So when I am asking, I am saying please deposit in my account $5 lakh. It is as good as I have bought dollars and deposited. So 5 lakh into what? 47.50. How much do we get? 2 crore 37 lakh something. I'll show you the language, don't worry, just put the figures for me. A New York bank wants to fund their account called Vostro account with the Indian bank by rupees 10 million. Now it is as good as they want to buy rupee. They want to buy rupee. That's the language in simple words. And when what dollar amount New York bank would deposit in the Indian bank account called Nostro account maintained in the New York when the interbank rates are. So basically, I have to deposit rupee in their account. They'll deposit dollar in my account. But the quotation is from whose point of view? Rupee deposit first. So what I'll do is first I'll put this quotation as 44.50 and 44.70. Confirmed currency is what? Rupee. I'll put rupee. Do not be, even if you're over smart or smart, do not try it in exam. Put this simple way: 1 divided by 44.70, 1 divided by 44.50. Now this has to be bought. Bought means asking 44.50. 44.50. You're buying that currency. So it's 10 million into, it's into only, divide automatically comes by this. So language when I write in the exam, or how to write in the exam, because he is using word Nostro, Vostro, etc. I think solutions slightly will change. It was 50 na first one. First one 50. 52 will become this. So the way of writing the answers, I am showing you two parts here. Indian bank wants to fund their Nostro account with $5 lakh exchange rate. Overseas Vostro account will be created by this much. That's it. Second example, what we did, New York bank wants to fund its Vostro account with rupees 10 million. For me, confirmed currency is nothing but rupees. So its exchange rate was given. I'll bring rupee on the left hand side. It's as good as buying. So they'll say deposit rupee. That means I'll say buy rupee. If you buy rupee, exactly same thing, you deposit in my account in dollar term. Indian bank Nostro account will be created by what? 0.2247. Try the next question, please. Try the next question. Look at the figure. What has to be bought or sold? That's it. Try the next question, please. Next question what we have is ABN AMRO Bank Consumer wants to purchase 15 million, as good as buying of what? Piece 15 million. Rates are given to you. $1 is equal to rupee term na. $1 is equal to rupee 51.365, 1.8370. 1 rupee would be equal to 1.3, and he wants to purchase. So what rate you will pay? 51.365. Languages you can look at in the question, so it does not make a difference. Language accordingly you can make out. Okay. Next part is a cross currency. Let me read that out. The moment you will read, this came as a part of a theory actually. So I am assuming since the examiner who gave this as a theory, this could be part of the MCQs, or the one of the questions there. He can give you 2-3 choices and give the answer. Problem is, there are two answers which can come. One when we round off and when we do not round off. Only challenge in exam what to do. If normal question comes, I'll suggest you write both, because I do not know whether they'll round off or not in exam, because it will not take a time. In normal scenario, if the MCQ comes, I wish they'll give only one answer which match your answer. XYZ Bank Amsterdam wants to purchase rupees against pound. From here we can make out what we have to find. Rupees against pound. So rupee is a chocolate. Rupee is confirmed, na? Is chocolate. So we need to find pound per rupee. Be careful, because you are specially attached with, you are not habitual of finding rupee as a chocolate. You find answer in the rupee. In this case, rupee is a chocolate. He wants 25 million rupees against pound, and ask rate only, buying. Ask rate. So from the prima facie I can come out, I need pound per rupee, ask rate. Sorry. For funding their Nostro account, and they have created their Loro account with Bank of London. Calculate the amount of pound created. Calculate the amount of pound created. Ongoing interbank rates are dollar, rupee and pound. So you have $1 is equal to rupee. That means if I write quotation this, you have been given rupee per what? Dollar, and you can make it what? Dollar by rupee. Fine. This is given as what? Dollar per pound, and you can make it as pound by dollar. Now we do not apply the brain. I'll tell you when solving answer. Brainless do this cross currency. What is happening we don't know. Pound on the top, this, and rupee on the bottom, which multiply and get the answer. What does exactly mean? It means nothing. With the pound you buy dollars, with the dollar you buy rupee. That is the logic which comes out. Even if you try that logic, it will fit in the same. Otherwise in exam you have to identify this relationship, whether it's pound per rupee, rupee per pound, whether it's a bid rate, ask rate. Same thing will do if cross currency comes in the cancellation or any other question. One of the question I've taken a lengthy question which I'll show you. Some cross currency will come. How do you think in that question? So accordingly you can arrange yourself. Was given to me rupee by dollar, I converted dollar by rupee. Dollar by pound was given, I have converted pound by dollar. Objective was very clear, that what has to be done. It's a rupee bottom and pound on the top. That means I'll multiply second and fourth. Sir, what is the meaning of it comes? When we'll try to understand the meaning, it might come. He'll buy, because he want to buy rupee. Two ways of thinking. To buy rupee, how many dollars required? To buy dollars, how many pound required? So that is exactly the logic of this relationship will come out. Let me show you this. If you look at this, was 53rd or 54th? Slightly changed. XYZ want to purchase rupees 25 million with pound. Hence we need to find pound per rupee. Ask rate. Pound per rupee. Ask rate. The $1 is equal to 61.3625, 61 point this, and these relationship were given. In exam, advice would be, please one answer calculate this, which is rounding off, because you cannot make out with round off or not. Second answer is this. You do not round off. If you do not round off, what has been done is, sir, basically 1 divided by 1.5260. What rates are applied actually? It's an asking rate, na? So both are ask rate. This rate is applied and this rate is applied. If I solve this rate, my answer comes 1 rupee is equal to pound 0.0107. And if I do not solve, sir, what is 10 to the power 6? Million has 6 zeros. So we have taken, sorry, million has 6 zeros. So instead of writing 25,000,000, taken 10 to the power 6. In exam, both the answers leave, because you never know what he'll give. I am more than 90% sure, they should give you both the answers. But in exam, rounding off can come, especially this type of a question. Otherwise, if they have mentioned the quotations in point form, answer can come in the point form. If they have not mentioned the point form, the answer would be point form. Since 53rd, look at that. It's a cross currency. Nostro Vostro is just to confuse you, nothing else. That is just for the sake of a confusion and nothing else. Look at that, please. Remind me at the end, I'll show you one controversy, I think, and say amendment which has come basically. Although I do not love that, they have fundamentally made a mistake. Just check the answers, that's it, nothing else. Done. Next is swap points. Come handy. Lot of questions. Calculation of forward rate using swap points. Calculation of forward rate using swap points, forward points, or premium points. You can call it as a swap point, forward point, premium points, and discount points, anything. On slide number 26, I'm on. If $1 is 60.20 oblique 30, so we call it as it's a 60.20, 60.30, 40, 50 would be 0.40 and 0.50. Forward rate would be 60.60 and 60.80, which comes out. Now, reading the how do we read these points? If the swap points are low high form, that's low high 40 50, low high form, or in ascending order, you can call anything. 40 50 is nothing but low high or ascending order. The forward rate would be spot rate plus swap points. Left hand side currency at a premium, right hand side currency at a discount. Case 2, in case swap points are high low form, it's a high low form, they are or descending order. I've taken the example here. The forward rate is spot rate minus swap points. Left hand side currency will be at discount and right hand side currency will be at a premium. 60 40 oblique 60 is 30 20. So we'll do 60 40 minus 0.30, 60 60 minus 0.20, 60.10 and 60.40, which comes out. I'll give you one question which you do not have. That will have, you will tell me link with which question and try quickly and solve the answer for it. For you, one question. Fact. Forex. cleaning exercise, don't worry. 63 in your notes given. 63 is given. Yes, not given. Fine. Do it from my. This question has link with question number 5. I maybe would not have given because of that reason, but it involves the swap point concept. Quickly try out. I give you 5 minutes. You give me the answer. I have given the hint. This has link with question number 5. Additional point is that swap points. You can do roughly. I don't require any kind of formats. Just quickly calculate the answer. So what was fifth question? When you flip over fifth question, you will come to know. The fifth question was pay immediately or pay after 3 months time. If you pay immediately, then you have to take a overdraft in the rupee, and if you pay after 3 months time, I'll show you this. And if you, the exporter gave choice that you can pay me after 3 months time by paying interest on dollars. Quickly try out, please. Additional point is swap point. I just need the answer from you. Quickly try out. Once you've done, let me know. Pay after 3 months. What answer do you get? 60? Like something. Number what? Will not have, don't worry. The only objective was swap points were given low, high, high, low. the discount points 61, 80, 750, and second one 62, 925. Which alternative better? Which one? First one. Pay after 3 months. In fact, without solving only you would have known that it was first option better. Why? And the fundamentally question was wrong. Fundamentally question was wrong. Not that discount points or something. The dollar interest rate, rupee interest rate is what? 14. Dollar interest rate is what? 10. Which currency should be at a premium? Dollar. Whereas dollar is trading at what? Discount. Fundamentally there was mistake in the question. Both ways you are getting a benefit out of it. That's why the first option came better, because actually this was 10% lower. It should have been at a premium. The points should have been what? The premium points, whereas they were given as what? Discount points. So there was a challenge in the question. There was a challenge. Now let me go back. Another question. Fine. Try 69th. Try 69th. On April 3, 2016, bank quotes the following spot rate: $1.2525, 67.5945, 2 month swap points, 3 month swap points. Spot transaction review is made after 2 days. This is actually the rule of a spot. Assume 5th April, swap points are 0.0001. That means these should be read as 0.0070, 0.0160, and so on. You are required to ascertain swap points for 2 months and 15 days. June 20th, basically from this date he is calculating. The difference would be, you're standing in the 2 months. In the 1 month it's 160 minus 70. So 90. 90 is for 1 month. Similarly in this, so half month would be 15 days, would be 45. 2 plus half days is 70 plus 45, 105. In this case it's 186 minus 90. This difference is for 1 month. How much? 96. Difference is for 1 month. 15 days, sir. Why 15 days are we taking? Because calculate for 15 days. Months and 15 days. 15 days would be 48. With this plus 48, how much? 138. Swap points are premium or discount here? Premium. The swap points are premium. So it's a 45 at 115. 115 and 115, sir. How did we get? Basically what you do is difference of 1 month divided by 2 plus starting point of 2 months. 2 months already you've reached, you add 15 days further, assuming evenly distributed. Determine the exchange rate for this Basically, if they are standing on April 5th, you will add them and calculate the rate. Third point was actually disputable. We'll do it accordingly. Two parts, if I show you the answer for parts, 12 points, 2 months and 15 days. Bid rate, ask rate. 3 months swap points were given 160, 186, 70, 90. Difference comes 90 and 96. For 15 days will be 45 and 48. For swap points for 2 months and 15 days will be 115 and 138. Exchange rate for June would be bid and ask $1. Swap points premium point, and he said it's 4 decimals. It's given basically it has to be at 0.0001. That's point very small number 0.00115, 66.2640 and 67.6063 6083. Now it's a one thing we know, there is a premium in the ask rate and premium in the bid rate. If he says calculate premium, let's suppose my formula is very straightforward, forward rate minus spot by spot. The language was very weirdly used, so accordingly the answer has been done. If you look at the language, third part was a language problem. He says compute the annual rate of premium discount. No problem on that. On dollars, if it is dollar has to be left hand side, left right when we go. So it's basically, for example, we say $1 is 70, $1 becomes 72. How much is the premium? We say 72 minus 70 by 70, forward rate minus spot by spot. He says compute the annual rate of premium or discount on dollar INR on an average rate. That was the problem, on an average rate. I don't know how it comes in the mind of the paper setter to create such question. Now average rate was basically what has to be taken. Was it a single rate should be taking, or bid premium and the ask premium, average of a bid, average of ask. So prima facie it appears as if the bid premium would be separate, ask premium would be separate. We know the premium points are nothing but these. Basically these points should have been divided by the spot rates, but instead of dividing them by spot rate, we'll divide them by average rates. So what has to be done is you have to calculate the premium points based on the average rates. So bid spot rate you know, so bid forward rate you know now, average bid rate you will calculate. Based on that, the points of the premium is nothing but 0.0115. This 0.0115 divide by what? The average rate, and when you divide by the average rate, you'll get the premium. Otherwise, by prima facie when you do, it looks very cumbersome. It was not so cumbersome. Straightforward would have been the forward minus spot by spot. 0.0115 is nothing but difference of the forward and the spot. So the swap premium point divide should have been by spot rate. Since he used the word average, so it has to be average of the bid. You have to take these two rates, and if you have to calculate on the ask rate, you take the average of the fine. Check once quickly. Once you've done this, let me know. Done. Let me try a question with you now, which will give you revision of majority of the chapter. Exam advisable not to try at all, please, or try at the last in case you get stuck. Question comes, cannot help it out. How examiner set such question, I don't know. Came first time in 2013 November, then one or the more exam it would have come. Question number 66. And worst part is there appears a fundamental problem which I will not tell you. I'll tell you maybe in the last session or when we are ending up. Question number 66. These kind of questions are good for practice to test your speed, and they'll set your momentum in a pattern basically. You read question once, then I'll read out with you, and then we'll make a framework what has to be done. Actually, November 13 was such weird paper. No matter which question you touch, all were out of the box. What to leave, what to try was a difficult task. Let me read out a question with you. It says your bank's London office has surplus funds to the extent of $5 for a period of 3 months. The cost of the funds to the bank is 4% per annum. Do not try to read much into the language. Surplus fund are there, then how the cost comes. Do not create. There is a costing involved, costing loss. How do they have? I don't know. Anything they have the funds and their costing involved for that fund. That means the 5 lakh will have a costing 4%. Maybe the opportunity cost. Anything is there. The London office has surplus fund to the extent of $5 lakh for a period of 3 months. Cost of the funds to the bank is 4%. Is proposes to invest these funds in London, New York or Frankfurt, 3 places, to obtain the best yield. Yield is nothing but return without any exchange risk to the bank. That means he will cover up by the forward contracts. The following rates of interest are available at the 3 centers for investment of domestic funds there for a period of 3 months. London 5%, New York 8%, Frankfurt 3%. The market rate in London for US dollars and euro are as under London or New York. Now question is set so weirdly. I am telling you 100% the paper setter should be given some extra amount to redo the question before setting up. Means from wherever he would have copied, even they would not have realized what fundamental mistake is there. You will also not realize, don't worry. I'll tell you at the end what is there, because some principle gets failed. By looking at the question, the first problem comes in, since we are in India, they do not understand. There are articles who get 5,000 rupees stipend or 10,000, or some of you, how much is basic stipend now? 6,000, sorry, 6,000 as per rules. 4,000 get, so 5,000 is justified. How can we think of Frankfurt, Germany? You should give what is euro, what is dollar. Nalaik, we have not even seen the passport stamped, etc. Someone called up me today in the morning from my close friends. I'm going Dubai. Which card should I take? Forex card. Now how do I know which card to take? Now you are a teacher of FM, you do not know Forex card. Why I do not go outside Forex? How do you know Forex card? Means same thing I am assuming. When I have not seen the world. I have actually, to be very frank, I tell the class also, I have my passport renewed 3rd time due, but I have not seen the foreign country. First I was alone, funds were limited, then 2 funds were limited, then 3 funds were limited, now 4 funds will always be limited. capital rationing project. Anyhow, my objective was they keep writing London, New York, London, Frankfurt. Now this currency is euro, pound, etc. Which currency you are talking with respect to what? At least some basic hint they should be given in exam. The problem is not with the question. Problem is the way they said the question. And problem is the length which they said the question. This question why I am covering is my objective is not for the exam perspective. I would have said if you do not have a choice then only try these kind of questions. This I'll show you in one in the portfolio also. That revises the entire portfolio. They'll ask you everything under the portfolio, whatever is there. It came in 2016, November I think. They ask everything that sort. These type of question only tests the skill of the calculation. Now in this case, I know London, New York could be, he's talking about, because London you are comfortable, you know it's a pound and this will be dollar. Anywhere they have given London, US dollar and euro. So Frankfurt would be third, London on this. So this will be pound, this will be euro. And at which center will the investment made and what will be the net gain to the nearest pound? Answer has to be in the pound terms, which comes out to the bank on the invested funds. Now objective is invest in the London, that is pound, invest in New York, that is dollar, Frankfurt is where I don't know, but it says euro, it's euro. Frankfurt is somewhere. All of you are like me only, it's okay. I'm saying now, they do not imagine they're setting paper for whom? Setting paper for small stipend getting article. Set them Kerala, Karnataka and make them foreign countries, give them the currencies, still manageable. Frankfurt, who has seen Amsterdam, where is Amsterdam? And half the time, you know, paper will do what? Amsterdam. Which place this is? Exactly, this is actually genuine problem. It's not about you, I'm saying. I was watching that movie which came based on which one? No, half see it, don't see it, you'll get demotivated. Nalayak. What they wanted to show, I don't know. I watched it, I thought I'll get motivation. They demotivate, keep giving attempt. This is Nalayak, this is not the way. It was demotivated at a point of a time. Not that movie, that was series. Do not watch. If you watch, move it from the mind. He makes the student prepare for IIT, which Hrithik Roshan was the hero. Super 30. Children were very intelligent, but they went to the new environment. The moment they went, everything they forgot. It happens, na? It does not happen with you. It happens with anyone. Same thing I am saying. This kind of a fascinating world they give you. Frankfurt, Amsterdam, one of the currencies, DKK for example. When first time we look at this question, DKK, which country? After a point of time, I started realizing it's a chocolate, it's a price, chocolate and price, and leave which country this is. Half the problem comes, we start assuming which country is this? Because there are 202 countries, currencies, the problem starts from there. In exam, especially this chapter I'm saying, just focus on something is there, it's a pound, or because 5 currencies are very common. Pound, dollar, euro, rupee and yen. If you give the currencies around them, it's okay. They try to mix up and then they give the logic that we are preparing students for international level. Pay the stipend of the international level, Nalayak first. They're preparing. Look at them. I'm saying I'm 100% saying if I would have given recommendation, I would have told them once on and off when we meet. I told them when paper examiner is setting a paper, ask them to solve in a given point of a time. He will realize the problem. November 13 was such lengthy paper, you cannot solve in 4.5 5 hours. It was such lengthy. These were the type of questions which were there. This question itself was problem. Then there was a problem problem is 5 currencies you have to know by heart in the exam. Pound, euro, dollar, rupee and yen. Relationship also you should know, because in the last class, in the last, when I am ending the chapter revision, I'll tell you a controversy which happens. In 1 pound more euro comes, in 1 euro more dollar comes, in 1 dollar more rupee, in 1 rupee more yen comes. That's a fundamental relationship of the currencies which is existing and which will exist for a long period of time. It does not mean they are strong or a weak. It's only that prima facie when you get confused that which currency will be In 1 pound more euro will come, or in 1 pound more dollar will come. So in 1 pound more euro, in 1 euro more dollars, in $1 more rupee, and 1 rupee more yen. In this question, this currency was also this fundamental principle was also failing. When you try that out, that was basically this was reversing. They were. These challenges remain in the exam. So if someone would have done blindly, he would have done. But if someone would have logically seen, he would have made a mistake. It was coming out here. So my objective here was which country should I invest. It was, let's suppose in dollar I go. Dollar was not challenging because the 0 period and 3 months time. I'll just diagrammatically do it and show you the answer. Don't worry. Dollar investment he'll do, and in dollar he'll earn proportionately what? 8% proportionately. Inflow will come in which currency? Dollar. And there is a cost involved in dollar, which is approximately, he's saying what percentage? 4%. So dollar outflow. Balance, I'll know what will come. So whatever I get net inflow, that I have to convert into what? Nearest pound. And since I'll be converting at what rate? After 3 months. So I'll require what? 3 months? Forward rate. And in this case, that means using spot rate and 3 months rate, using this and this, I would be able to calculate 3 months forward rate, and they are given what? Premium points or discount points? Premium. This is premium in the first case. I can calculate that point. Then second is when I go to invest in the London, that's basically pound. So I have available dollars. Dollars in 0 period I convert in what? Pound. And then I'll convert and realize what? Pound. The dollars would be outflow. This I need to convert in the pound, and then I can get the answer in the pound. Third is euro. Now I have availability of a dollar, but the dollar and euro relationship is not available. Dollar relationship with the euro is not available. I'll have to use the pound dollar relationship, pound euro relationship to find cross currency and then do it. So it was slightly lengthy. You can see from the size of the slide. You have the data available here. Just keep checking the data. Slide first, I'll speak out the slide with you. Then you can see the answer in your slides. Just look at the data because data was slightly cumbersome in this question. These type of questions are perfect practice questions for the exam. Question number 66. Look up please. I've written revision only. These normal way it takes more than 1.5 hours if you start solving 1 hour to start solving properly. If investment is done, you keep yourself on the numbers and then you read out. First I'll read out with you. If investment done in London, the New York, dollar investment, dollar cost, dollar is giving you return of 8%, costing is 4. You'll get dollar inflow, dollar outflow. You'll get what? Net inflow in dollar. Convert to pound at what rate? Forward. Sir, why are we converting to pound? Because question said in the last line nearest to pound. Dollar equivalent gain 5 lakh. I've directly done 8 minus 4 into 3 by 12. I get what? 5,000. 3 months swap points were 80, 85. They're nothing but premium points. So using that spot rate, I think 1 pound dollar is 1.5350, 1.5390. Premium points 0.0080, 0.0085. I get this rate, and then I bring dollar on the left hand side. This rule do not forget, else we'll make a mistake please. Dollar on the left, and then I have in hand what? Dollars. Since I have in hand dollars extra, I will not buy. I will do what? Sell. Sell dollars. So selling of a dollar is as good as buying by the bank. Bid rate. It's a bid rate applied. So pound equivalent gain comes pound 3231. Second part was important from the perspective. You have dollar available. You have to convert to pound at what rate? Spot rate, and then invest and earn interest on pound. Realize what? Pound. This is not the challenge. Dollar costing was 4. You will know how much dollar here. This outflow which is there, you have to convert at pound using what rate? 3 months forward rate. Now in this case I have what, sir? I have available, first is 0 period, today. The word is today. Convert 5 lakh pound dollar into pound at spot rate. Since confirmed currency is what? Dollar. You are not buying dollar, you are doing what? Selling dollar. Since you are selling, the bank would buy, bid rate to apply, left to right will multiply. Sell dollars, get pound. Objective is sell dollars, get pound. You will get 324,886. plus interest 5% for 3 months you earn, that will give you a realization of what? 328 497. You can cross check the numbers later on, please just get the flow of it. Dollar available, sell dollar, get pound, on pound, earn interest, at the end earned the realizable pound. Now the question remains is dollar. Dollar equivalent payments are by, because you had taken the dollar and converted into sold dollars and got pound, you have to return back that dollars also. 5 lakh dollar interest on dollars, it will be 5 lakh 5,000. Since I have to repay these dollars now, it will be by dollars. After how much time? 3 months. So 3 months time we have applied buying dollar. Rates we calculated in 0 period only, 1.5430. It's buying of the dollars now. So why buying? Because this dollar which you bought, you sold and converted into pound. At the end, when you return back those dollars, you'll have to buy. So basically when you buy, it's asking for the dollars, these many pounds required. So pound equivalent gain would be inflow of pound which you calculated on the previous slide minus this outflow. So your gain in pound comes 1,1. This was not a challenge at all. Third point was challenge. Because you want to invest in euro, relationship of euro is not available. You have to use that cross currency. What objective is? You have dollar available. You have to convert to euro at spot rate. Convert to euro and realize euro. This dollar will not have a problem because this part you have already solved here. It will be exactly same. The problem will be two. First, when you convert to euro, that means you need spot rate relationship between dollar and euro. Second important part is when you realize euro, you have to reconvert into what? Pound. Sir, why first part will not have problem? Because this will be exactly same. This part would be same. That is not the challenge. Now what will happen, sir? Need to sell dollar, invest in euro. What rate I have available is pound. I'll convert in dollar, pound, dollar. Now why have you written, sir, need to sell dollar, invest in euro? Because what I need to find, that is very important. I need to, I'm using language what? Sell dollars and buy what? Euro. So what has been done is sell dollars. Confirmed currency was dollars. I need euro by dollars bid rate. Dollar on the left hand side. Generally, what have you done? Look at this part, please. When you had the relationship of a dollar and pound, you sold dollars, got what? Pound. Similarly, think, suppose you would have had the relationship between dollar and euro, you would have still sold dollar and got what? Euro. Means basically what I am trying to tell you is, if I give you relationship of a dollar and pound, objective is if you are going to London, selling dollar, getting pound. Instead of going to London, if you are going to Frankfurt, the objective is still same, selling dollar and getting what? Euro. So you would need this rate only. And confirmed currency in hand is what? 5 lakh. So my objective is to find this part which I find here. Need to find euro per dollar, which rate? Bid rate. And when I need euro per dollar bid rate, euro on the top and what on the bottom? Dollar. So how do I read? I'll sell dollar, get pound. I'll sell pound, get what? Euro. So when I multiply, I get the spot rate, pound equivalent investment I get. Then I earn the interest on it and I get pound equivalent amount after 3 months. Convert this pound at 3 months forward rate. Convert this euro at 3 months forward rate to pound. You have been given discount points, you calculate them, then you sell euro, get pound, and then you solve it. Looks so easy when you look at the answer and keep reading. If by chance you look at the institute answer, you cannot even read what they give. It was not a straightforward exercise. The problem was cross currency applied. Then second problem, look at here, relationship what I was telling you. It comes $1 is equal to these many euros. In $1, more euros cannot come. There was a challenge in this question. If you fundamentally would have known, you would have got confused here itself. What is happening? So sometimes the relationship can come very weird. It's okay. Otherwise, fundamentally, this relationship should hold. What I was telling you that time. So in this case, these diagrams should help you out. What are you doing? So in the first case, it was dollar. Challenge was not there. In the second case, it was dollar, convert to pound, realize pound, challenge was not there, pound was straightforward. Third case, when you convert to euro, you find the cross currency. Objective is same. I write exactly what I do. Need to sell dollars and invest. Sell dollars. Selling is dollar because dollar was a confirmed currency here. So selling of a dollar is as good as, no matter whether you are selling me or I am selling somewhere else. It's a bid rate only applied because quotation is from the second party point of view. So the bid rate was found, and once you get the realization of the euro with the interest, convert at a forward rate, calculate the forward rate, and then do data according. Now you can quickly spend 5 minutes, get the answer in data. Figures should be very comfortable, please. Make the language form what you're doing. Language is very important. Whether you're buying, converting, what you're doing, because the way you use buying and selling, exactly same way the language is created of a bid and ask rate. Last part, payment was not challenging because payment is exactly same calculated in the second part here. The payment was not the problem at all. Done? Cross check the numbers once, please. Just get a comfort. Do it from the perspective as if you're revising. That's it. Nothing else. Try these type of question that gives you flow of the topic. You'll not fear about it because once you have seen these kind of questions, the fear would not be there. Objective was dollar investment, dollar realization, investment in pound, pound realization, investment in euro, euro realization. And since he said convert the answer in the pound, so first part convert the pound 3 months rate, dollar and pound. Second is coming in pound only, no challenge. Third is euro, you have to find the relationship of a euro, but 0 period conversion requires a cross currency of a dollar and euro. Done? One small question will do. Then after that, one controversy which I was talking to you, call it as amendment. I'll tell you when you go back home, you can see that out. You do a small with you. Pull down exercise. 3-4 times this question has come in the exam. 71. Question number 71. Small off track question. Company A is considering hedging its foreign exchange risk. It has made a purchase on 1st July 2016 for which it has to make a payment of $60,000 on December 31, 2016. So you're standing in July 1, payment is in December 31, that's a 6 months period. The present rate is $1 equal to 65, that's spot forward. This is relevant for you because you can do the forward contract at 64. The company will make upfront premium of 2% of the forward purchased amount. The cost of funds to the company is 12% per annum. Cost of fund is 12%. In the following situations, compute the profit loss to the company. Profit loss the company will make if it hedges its foreign exchange risk with the exchange rate on 31st December. Basically what it is doing is, the first we find is the cost of funds, that's upfront premium it pays, and the upfront premium it is paying on is 1st July. So $60,000 into 64 into 2%. How much do we get? 76,800. Since you are making this payment on 1 July and 31st December, 6 months opportunity cost will come on this, plus opportunity cost. Plus opportunity cost will be 76,800 into 12 by 100. This is called cost of hedging. Cost of $81,408. This you will bear, and you have freezed your rate at what? 64. This you have to bear, and the rate has become 64. Now he's asking if the rate becomes different, then whether you gain or lose out because of that. So this is your cost of hedging. Now let me look at what has happened. 81,408 will keep in mind. If the rate becomes 68, if the rate becomes 68 and you have done the hedging at what rate? 64. Cost of hedging, I am writing it here, that was 81,000. You end up gaining 68, whereas you will get what at 64 into saving is what? 60,000, but cost of hedging is 81,408. This is your net. If the rate becomes 68, your net would be, gain would be 158,592. Sir, if the rate becomes 62, that means you have lost 2 rupees on the rate, plus you have lost on the cost of hedging also. Loss comes total 201,408. 70 rupees, that's saving now. 70 minus 64 into 60,000 is your saving, and you have paid up 81,278. This is saving 278, 590, 65, 65 minus 64, 1 rupee saving on 60,000 minus the general question which has come 3-4 times in the exam. Cost of hedging you will anyhow pay. You just have to see whether this has helped you saving or not. Second part was loss because rate came cheaper, and third part is your loss. First and third part gives you. Fine. Now let me show you a question not there with you. When you go back home, you can refer your materials. This question everyone would be remembering. I think no one would have any doubt, no matter from where have you studied. Astro Limited, the word itself, Astro Limited, and the question started coming, I think, way from 1994, 98, 2007, 8, and so on. And recently twice it has come. Everything was same till now. Nothing was changed. Suddenly your institute has slightly modified the answer. Anyone who has noticed it? When you go back today, I'll just tell you, when you go back, open up your study material, whichever you have. In that, I think question would be unlimited. And tell me tomorrow, maybe they would have remodified. You have the study material. There is question unlimited. Just see, very good. Such intelligent student. As unlimited is there, 42 number question should be there in 40 series sum, if my memory is right. So very good. Look at these 42. For the numbers also. Which chapter? Foreign exchange. I'll go to Sun Limited only. Let me go to Sun Limited. And you know why they were modified? Because in recent exam this question was asked twice. and I think they have made a mistake by modifying. Now you only have to write the letters to them or do the same way what has to be done. It's not something which Sun Limited na. Alert Limited came in November 96. Alert Limited data is same as Sun Limited only. I'll show you that data of the Sun Limited. In fact, this came in what year? 96. This chapter I do it from 1990s only because keep repeating this. We also should have 40 series only. 42 if it is there, then it's ultra important by chance. Oh my god, 40. What they have done, this is the answer which I took from the institute, exactly same way, no change. I think your institute has done, if you look at the second part answer, it should have been instead of 0.45 and 47 they would have 0.90. You see your book, since you have the study material 90 na? Very good. And instead of that they would have last answers as these. The answer has come change of 0.02 fundamentally, but lot of change has come. It's 0.13 and 85.90. Is it so? Last lines. See the last line. A plus B cost is how much? 1006 point. So you also have study material. 13 and slightly changed here accordingly. Now what has happened? You will not remember Sun Limited, most of you. You'll remember Astro Limited because this generally used to give as a homework if I do it from my way. This is same as a Alert Limited, which is same as a Astro Limited. What happens in this question is, can I go back to the question? See, because I have diagrammatical presentation in the question, from there it becomes easier for me to. When you go back, you do it, modify your class changes accordingly, because in the last 3 years, twice this question has come. They have given this answer accordingly. I think the whosoever has given them the advice, they have changed without even applying brain, whether they are changing on the right track or not. Now this is question number Astro Limited diagram. I have Astro Limited. I'll just tell the feeling of this question. Astro Limited buys something from the Japan and then they have to make a payment. It is just like question number 5. It is just like question number 5 with one slight modification. In question number 5, it was exporter is giving importer two choices: pay me immediately or pay me after 3 months charges with interest. In this case, exporter says pay me immediately. Exporter says pay me immediately, but they are taking help of one of the branches which Indian bank has outside India. That's it. That means it's a case of today payment or after 180 days payment which comes out. If you make a payment today, you take a loan in rupee and buy yen at spot rate and make a payment. Rates they have given. Rates also, language was not nicely given, but over the period of a time, we have made our own way of understanding the question. If you read the question, anyone who reads first time, they cannot make out. Since we read it so many times, means you and me, we are able to make that this is Indian rupee, this is the foreign exchange, exactly same thing he gives. Or he says, SBI Japan says, I'll charge you 2% charges and 1% will come for 6 months time, and then 1.5% charge because I'll make a payment on your behalf today. You return me at the end of 180 days. And then we try solving first option. Take a loan in rupee, buy 7640 yen. We buy rupees, and he said, second line, tell me, it's a quarterly compounding instead of, what is language given? Quarterly rest. Quarterly rest was word given. So we have 60 and 61.80. No challenge in this. This is okay. Second part we have is what? This is first part. Second part we have, he says, avail the facility from Tokyo branch, Indian bank, yen will be paid after 180 days, 1.5, and since 180 days were given, he takes 365. I do not say it's okay. Every time you do the same thing, we can do the same thing. There is no challenge. And then whatever yen has to be paid. First chance was you take a loan in rupees, buy the yen, make a payment, repay the loan. Exactly same as question number 5 with quarterly rest. That's it. Second part, instead of taking a loan from the exporter, you have taken a loan from the bank. Loan from the bank, repay that bank whosoever given you the yen, and that will be repaid after 180 days at forward rate. Till here exactly question 5. Since he was charging you the commission of opening that account or charges, you have to pay him yen 76.40. Now you did not have 76.40. That means you will buy this by taking loan in what currency? Rupee. So if you take in rupee, ideally it should be exactly quarterly rest, which used to happen earlier. Now what they have done is, in the second part they do not take quarterly rest. I have no clue why. If you ask me very frankly, they have done, well, means this fundamental mistake, because when you are buying a rupee loan and second line says, if you look at the second line of the question, the second line tells you, the second line here tells you with quarterly rest, it's about rupee loan. Whether you take rupee loan to buy the yen to make a full payment, or you take a rupee loan to buy that commission charges and make a payment, it has to be quarterly rest. And it was same every time till the last couple of years, and that exactly change they have done. So what they have done in all questions, in whichever given suggested when the examination came, or the Sun Limited which came, which was the proof, actually I did not want to change, then this is basically they have changed. In exam, I think what will happen, someone will do the quarterly rest only, then results will come, and then videos will come. Nothing can happen. Institute will realize this way only. I don't know why they have made, actually you tell me, how can it happen that one loan, this you buy for, this also buying in 0 period and this also buying in 0 period. So they have done accordingly. If there is any other way, they should have given what has been done. So this answer I have modified as per, I could have called amendment has come. See, AFM amendment has come, and this is done. When you go back home, you can try your Astro Limited. Before trying Astro Limited, pick up the suggested of last 2-3 years, the same question would have come, and in your study material the Sun Limited question is given, which my book used to, and I have not done answer from my side. If you think that previous answer was mine, previous answer was not mine, previous answer was also of the institute. I copy pasted exactly same. I do Astro Limited task and then I give 1 or 2 as a homework, and this is same as Alert Limited of 96. They have done, I think it's 0.90. That means they have not taken quarterly, which they have done mistake here. That's the one problem here, and then accordingly answer would change. So if you remember, it's okay if you make the same thing, the everything would be same, last part would be slightly different. If no one realizes, you'll get full marks. If the amount figures are very huge, then there could be a problem, and I think institute, till the time they reconvert back to the original, or next time what will happen, safeguard their face, they'll say you take this or you take this, but there is no second option. When you have quarterly rest for the first one, when you have same rupee loan to finance the entire funding, then the LC funding when you're taking, and you are taking in the rupee term, that means you are buying this rupee, then it should be what type of a funding. And if there are some regulation, then they should tell us what regulation under what, that we pay for this quarterly is not allowed, pay for the first quarterly is allowed. In fact, by looking at question, I am saying anyone who will read first time will take half an hour to understand what rate will be applied where also. The language was not clear. By over the time, with the feelings, we come to know that this is the meaning of the question, this is the feeling of the question, and this is how it has to be done. Otherwise, no one knows that what is the feeling of the question. Astro Limited or Sun Limited, you can mark accordingly. That's cost of letter, the cost of credit. That second part, quarterly rest, they have avoided. That's one amendment. Rest controversies, I'll speak to you tomorrow. There are a few more controversies which are there. We'll wind up here. Tomorrow we'll move into the cancellations, modifications basically. Most important topic from your perspective, and maybe some new trend questions which has come. We'll look at the time and then take call accordingly. Take care and bye bye.